I am OG John Original. Global financial markets are navigating a period of significant uncertainty, with no clear resolution in sight on multiple fronts, from ongoing geopolitical conflict to major macroeconomic data releases expected later this week. Against that backdrop, the silver market is drawing renewed attention, as a widening gap between paper pricing and physical demand signals deepening stress beneath the surface of what appears at first glance to be an orderly market. At the time of this report, silver on the COMEX exchange is trading at $83 per ounce, having pulled back from a recent high of $86.90. However, on the Shanghai Futures Exchange, silver is currently trading at $95 per ounce, a premium of $12 over the Western spot price. That gap has persisted even through the recent paper price sell-off, suggesting that physical buyers in China are operating in an entirely different pricing reality than what Western brokerages are displaying to their clients. Several converging data points are now drawing attention from institutional market participants. COMEX open interest in silver has declined to 113,326 contracts, the lowest level recorded since September of 2013. For context, the all-time high for COMEX silver open interest was 244,775 contracts, set in February of 2020. That represents a collapse in participation of more than 50% from peak levels. At the same time, total COMEX silver inventory has fallen to 352 million ounces, marking a fresh one-year low. More than 53 million ounces have been withdrawn from the exchange over the past 30 days alone, a reduction of 13% in a single month. Alongside these inventory movements, institutional delivery activity, energy supply disruptions across 3 separate global flashpoints, and a significant position change by major trading firm Jane Street are all adding layers of complexity to an already opaque market environment. Digging deeper into the COMEX data, the registered silver available for actual delivery currently stands at 87 million ounces. With total open interest at 113,326 contracts, the registered leverage ratio has climbed to 6.68 to 1. That means for every single ounce of physical silver held in registered COMEX vaults, there are approximately 6.5 ounces of contractual obligations stacked on top of it. That registered inventory figure continues to decline. Adding further weight to the physical demand picture is the delivery notice data. On Tuesday alone, 607 silver delivery notices were issued. Goldman Sachs issued 400 of those notices, while Macquarie issued 200. On the receiving side, Bank of America stopped 195 contracts, and JP Morgan stopped 145. Total COMEX March silver deliveries have now reached 28.47 million ounces of physical metal being demanded through the formal delivery mechanism. These transactions are being executed by large institutions going through the official COMEX process, specifically to take physical silver off the exchange. The gold market is reflecting a similar pattern. 1,215 gold delivery notices were issued on Tuesday. Goldman Sachs issued 590 of those, while Wells Fargo issued 395. JP Morgan stopped 847 contracts on the receiving end. Total March gold deliveries have now reached 362,800 ounces. Institutions, across both metals, are not rolling their positions quietly into paper contracts. They are formally standing for physical metal delivery. A particularly notable data point concerns retail activity during this same period. Since February 9th, approximately 15 million ounces of physical silver were sold by retail investors. Under normal market conditions, that volume of selling would be expected to ease pricing pressure and reduce stress signals in the lending market. It did not. The one-month silver lease rate, which in a functioning market would round to approximately 0, remains elevated. The one-year swap rate remains distorted, continuing to price backwardation risk. 15 million ounces of retail liquidation entered the market, and the underlying stress indicators did not move. On the Shanghai Futures Exchange, silver inventories have fallen to 9.5 million ounces, with over 400,000 ounces withdrawn in a single day. At that rate of withdrawal, the SHFE would reach empty in approximately 24 days. Separately, the Shanghai Gold Exchange holds 14.3 million ounces of silver. Combined, Chinese silver inventory across both the SGE and the SHFE stands at 752 tons, or 24.2 million ounces, the lowest level recorded in a decade. Turning now to developments in the exchange-traded fund market that have been generating considerable attention inside trading circles. According to the most recent 13F filing with the United States Securities and Exchange Commission, Jane Street added 20.6 million shares of the iShares Silver Trust during the fourth quarter of 2025. In the quarter prior, the firm held approximately 41,000 shares. That represents a 500-fold increase in a single quarter. The position is now valued at approximately $1.3 billion, making Jane Street the largest reported holder of SLV, a position larger than that of BlackRock, which sponsors the fund. During that same period, Morgan Stanley reduced its SLV position by 3.7 million shares, while BlackRock added 0 additional shares. Jane Street's portfolio structure is notable in this context. More than 87% of the firm's portfolio is tied to options, making it an entity structurally built around the creation and management of volatility. The custodian of the iShares Silver Trust is JP Morgan, the bank that paid $920 million in 2020 to settle federal charges related to 8 years of precious metals spoofing. That settlement is a matter of public federal record. Within trading circles, price action patterns in silver are currently being compared to patterns previously flagged in Bitcoin, which were allegedly linked to Jane Street and which reportedly ceased appearing once the Terraform lawsuit became public. Jane Street is currently facing allegations across 3 separate asset classes: the Terra ecosystem collapse, findings by India's market regulator across 18 Bank Nifty expiry sessions, and the Bitcoin daily pattern. The firm has denied all allegations. As of the time of this report, no United States regulator has opened a formal investigation specifically into silver. Jane Street has not been formally charged in connection with silver markets. Shifting to the energy picture, 3 simultaneous supply disruptions are active as of this report. First, the Strait of Hormuz, through which approximately 20% of global energy supply passes, remains under declared Iranian naval supervision. The Pentagon has estimated the ongoing conflict is costing $1 billion per day. Iran has the capacity to produce up to 10,000 drones monthly at a cost of $35,000 to $50,000 each, compared to United States intercept costs of $1 to $3 million per missile. Goldman Sachs has stated that if Hormuz volumes remain flat for 5 additional weeks, Brent crude is likely to reach $100 per barrel. Iranian officials have publicly stated that if the United States and Israel pursue regime change, final strike missiles will target the Bushehr nuclear reactor and all regional energy infrastructure. Second, 20% of global liquefied natural gas supply went offline, with a 2-week restart window estimated. Coal futures surged 7.2% to $138 per ton immediately following that disruption, as the power sector pivoted to alternative energy sources. Third, Russian President Vladimir Putin has publicly raised the possibility of rerouting Russian gas away from Europe entirely, stating that if Europe intends to close the door within a month or two, it may be more profitable to stop supply now and move to more reliable partners. West Texas Intermediate crude is currently trading at $75 per barrel. Goldman Sachs' projection of $100 per barrel is based solely on the Hormuz disruption and does not account for the Qatar and Russia situations simultaneously. The broader cross-asset environment is also registering notable moves. Stock markets in Korea, Thailand, and Dubai were limit down. United States equities finished in positive territory. Germany's DAX recovered 3% from its session lows. Aluminum futures surpassed the January 29th highs and moved 5% higher. Bitcoin reached $74,000. Gold is currently at $5,135 per ounce. Venezuelan oil is also reportedly flowing again following an announcement by President Trump, though the oil market's response to the naval escort order issued by Trump for Hormuz shipping was short-lived, with prices recovering fully within hours. As this report has outlined, the silver market is presenting a set of conditions that span multiple dimensions simultaneously: declining exchange inventory, elevated physical delivery volumes, distorted lease rates, a record Shanghai premium, and a dramatic shift in ETF positioning by one of the world's largest trading firms. Each of these data points carries its own significance. Taken together, they describe a market in which the paper pricing mechanism and the physical supply reality are operating at a considerable distance from one another. On the COMEX, open interest has fallen to its lowest level since September of 2013, less than half of its all-time peak. Registered inventory stands at 87 million ounces against a leverage ratio of 6.68 to 1. In the month of March alone, 28.47 million ounces of physical silver have been formally demanded for delivery through the COMEX process by institutional participants, including Goldman Sachs, Bank of America, and JP Morgan. On the Shanghai Futures Exchange, the withdrawal rate is such that available inventory could be exhausted in approximately 24 days at its current pace. The $12 premium between Shanghai and Western spot pricing has held through the recent paper sell-off. Against that backdrop, market participants are also monitoring 3 active energy supply disruptions: the Strait of Hormuz under Iranian naval supervision, a 2-week liquefied natural gas outage representing 20% of global LNG supply, and the potential rerouting of Russian pipeline gas away from Europe. These three situations are unfolding simultaneously and are being reflected across energy futures, with coal up 7.2% and Goldman Sachs maintaining a $100 Brent target based on the Hormuz situation alone. For context on the week ahead, two high-impact economic data releases are scheduled. Unemployment claims are due Thursday, followed by non-farm payrolls on Friday. Both carry significant implications for the United States dollar, and the dollar's direction remains a key variable for metals pricing in the near term. The January 15th DXY closing level has been identified as a reference point. A confirmed close above that level would be expected to place additional downward pressure on metals. What the data presented in this report makes clear is that the physical silver market is registering signals that diverge meaningfully from the paper price. Lease rates remain elevated despite 15 million ounces of retail liquidation since February 9th. Chinese combined silver inventory across the SGE and SHFE sits at its lowest level in a decade. And Jane Street now holds the largest reported position in the iShares Silver Trust, a 500-fold increase from the prior quarter, at a time when the fund's custodian, J.P. Morgan, carries a settled federal record of 8 years of precious metals spoofing. No formal United States regulatory investigation into silver has been opened as of this report. Jane Street has denied all allegations across the asset classes in which it faces scrutiny. The facts on record, however, continue to attract attention from institutional market participants and analysts monitoring structural conditions in the silver market. This has been a full market briefing. We will continue to monitor developments across silver, energy, and global financial markets and bring you updates as conditions evolve.